Hey everyone, thanks for getting on this webinar. We've given it a few minutes to give everybody some time to get on here, so I think we're going to get started. Yeah, thanks for taking time out of your day to join this webinar to just learn more and keep getting educated in finances. So glad that you guys are here. For those of you who are listening to the replay, or especially those for listening to the podcast version, if you're just listening to the audio, I will in the podcast notes, you will see a chart book, so you can reference the charts that we're talking about here. As you're listening, just so everything all makes sense. But yeah, we're just, happy to have you guys here, and we're going to go ahead and get started. So today's podcast, like always, trying to stay consistent at doing these the first Tuesday of the month, so that we give you guys a chance to, again, just continually stay educated in, with what's going on in the market. I always say an educated investor is a confident investor, is an empowered investor. So I want to make sure you guys, stay educated and understand what's going on. So we're going to start there, as always, with the market update and just give you kind of the rundown of what's been going on in the market. We're also going to just really do a focus on the first half of the year, since we now have the first half of the year under our belt. So we can kind of look back on how the markets did the first half of this year, and what that we can expect maybe to see the second half of the year. And then just our financial literacy topic that we're just talking about this month is just how to teach your kids about money. So we'll be walking through that as well, and hopefully leave you guys with some good tips on that specifically for your kids, or maybe, you can share with the parents in your life as well for maybe grandkids. So, always start with just, who is Selah? Selah is, we're a holistic wealth management firm that was located in California, but serving clients nationwide. Founded in 2019 with the goal of bringing confidence and organization to people's financial life through education, stewardship, and empowering wise decision making. So this is that education, stewardship piece. Again, just always trying to make sure you know what's going on. You kind of feel that education, so that you can just feel empowered with your finances. Selah serves, millennials and families in all different life stages, and retirees. So just a little bit about Selah. Goals always of these webinars is to, one, give you a better understanding of the current markets and just what's going on, and two, to give you some tips and ideas on how to teach your kids about money. That's the second goal for today. And then always the goal is for you to become a more confident investor. So we just want that to be just the main goal of where, how you guys feel about your investment. So we're hoping to always, bring that to the table, always help you become a more confident investor. If you have any questions during the webinar, please text this number. I don't always get to the questions at the end of the webinar, just for time's sake, just to give respect to everybody's time that are on here. So I can answer those personally. If we do have time, I'll try to get to them. If not, I'll answer them personally. Or a lot of times, they're you guys sending some good questions for future webinars as well. Somebody will just, if it's a larger question, we can cover that in a future webinar. But and even if you're watching the replay, go ahead and send those in, because I can answer those at any time. That is my text line. And so, we'll get to those questions. So let's dive in here on the market update. We're going to go, first kind of a quick look of what the market, where it finished at last week. Again, this is a Tuesday. We're going to look at where it finished last week. And we're also going to look at first half correlation comparisons. Like I said, looking at the first half of the year and looking at past years, see what we can compare for where we might expect this second half of the year to go. And then inflation, and just looking at how inflation is easing, which is a nice report to finally be looking at. So here's a quick look. And again, if you are listening to the audio, these charts are below in the chart book, but a quick look, S&P 500 as of last week finished 15.58% year-to-date return. You can see that up on that chart. The NASDAQ, really has had a big first half of the year with a 31.12% year-to-date return. That has been led strongly by information technology. So you see that there, in communication services. So just as a reminder, the market is in a new bull market. So this means that the market has gained more than 20% off its low from last October. So, a bear market is when the market falls 20% or more. A new bull market is confirmed when has gone back up 20% off its low. That confirms a new bull market. So we are in a new bull market. A new bull market has officially started. All major indexes ended the shortened trading. We had shortened trading week last week with 4th of July. They entered that last week lower, actually. But it's kind of the first week of the second half of the year. But communication services performed relatively well this week, actually, because for those who haven't heard, Meta released Threads, so like kind of their rival to Twitter this week. And so that was the platform, received a lot of fanfare. That was like 70 million subscribers signed up for the service. Just one day after its launch. So, communication services obviously had a really big bump from that with Meta. And the big data for this week that we're kind of looking for to be released is going to be tomorrow. We will get the June Consumer Price Index to see how inflation is looking. So that obviously is always something we're very paying strong attention to give us kind of a continual insight as whether or not the Fed is going to stick with a pause or if they will, want to keep raising rates any further. So, that's obviously an important data going to be released later this week, tomorrow. So we will, see how that goes. But this is kind of a quick look again where the market currently stands as of end of last week. So here's the second quarter. So this is the second quarter chart. Again, just looking kind of at that June 30th close and where everything ended for the first half of the year, but specifically this is the second quarter and how everything did. The S&P 500 continued its really strong 2023 in the second quarter. It returned 8.7%, as you can see here in that Q2, including dividends. Large and small caps both delivered gains during the second quarter, but you can also see here that large growth outperformed small caps. The Russell 1000 index, that returned 8.6% compared to 5.2 for the small cap Russell 2000 index. So that kind of shows you that difference there. So year to date, large caps have more than doubled their small cap counterparts. So 16.7% to 8.1%. So large caps have been, here it's kind of showing the large growth, but large caps have been, the better investment so far for the first half of this year. So LPL research really favors actually large cap stocks moving forward as well for the second half, just due to that, still elevated recession risk that we're in. Still kind of looking for large caps to do, probably still outperform those small caps, which is where we are in the market cycle. So this chart here is talking about correlation. So let me kind of explain what's happening here in this chart, and then we'll dig into the numbers further. But this is a chart that is showing the first half of 2023 and trying to correlate it with another year going back to 1950. So this is looking all the way back to 1950, all the first halves of the year since 1950 to see which year 2023 most relates to. So as investors, we're often looking back into the past to get an idea of what is coming around the corner in the market. That historically, sometimes we can just look at historical trends and, maybe get an idea of what might be coming. Obviously not always guaranteed, but just gives us an idea. So this chart is a first half correlation chart that is looking to see where the first half of the 2023 compared most closely to another year. So you see here, 1958 was the highest first half correlation to 2023. So the most similar in return. Here, this is like, obviously these are all the ones that compared similarly, and these are all the ones that don't compare at all. So you only see a good handful of years that were higher. And that's because the S&P 500 gained 15.9% in the first half of the year. So that is a very impressive first half. That is actually the 10th best first half in 73 years. One of those random statistics. But the average first half of the year actually only has a return of 4%. So we well outperformed the average first half. So that is why there's not as many years to look back on for, to see correlation. So you can see from the chart, there's only a limited number of years since 1950 that they've had, other years have had a similar first half to 2023. So let's get into the actual numbers here of what that means. So again, here's all the years, those higher bars on that last chart. This is all the years with the number. So 1958, in terms of closest analog to 2023, 1958 has the highest correlation coefficient and comparable first half return to 2023 with 13.9%. However, the macro environment during that time in 1958 was very different to 2023. You can see that the first half of 1958 overlapped with a recession, which we did not have the first half in 2023. And it had a downward trajectory of the federal funds rate. So again, we did not have that. We had federal funds rates going up. So that part of 1958 doesn't really correlate well, even though this return does. So then you're looking down to, we come down here to 1995, has the strongest, a high correlation in 2023 in terms of relative in terms of return, but also in terms of relative similar macro backdrop as well. So that's where the difference with 1995 and looking at that year. So it has 18.6 return in the beginning of 1995, 13.1% return in the second half of the year. But 1995, the first half of 1995, it was also a pre-election year. And the Fed had paused a very aggressive rate hiking cycle after tackling higher inflation. Sound familiar? And the difference, or what happened in 1995, is that they were actually able to avoid that recession. So they did have a soft landing in 1995. So no recession, higher, here we go. No recession, higher federal funds rate trajectory, just how we are in the first half. But they avoided that recession. So they had this 13.1% second half return. Of the 10 highest correlated first halves of 2023, so all of these here, you can see these are the 10 best correlations. The S&P generated an average of around 12%, average and median of around 12% in the second half, with 9 of the 10 periods producing positive returns. So you only see this one negative here, negative 5.3, but all of these had very positive returns with that second half. So the strong first half did equal strong second half for the most part in these 10 years. So given the high relatively correlation between the first half of 1995 and 2023, and a similar macro backdrop of now versus then, LPL research used that second half return progression of 1995 to forecast the return progression of the S&P 500 for the remainder of the 2023. So what that means is they took, okay, where was the June close 30th? Added 13.1%, like if 1995 happened again, if we had a soft landing and that happened again, the S&P 500 would finish at 5,032 points. And, the LPL actually is releasing today. They've released their mid-year outlook, which we'll be talking about more in our next webinar. And they are talking for a little more modest gains than that 1995 gains. But this analysis does illustrate that there is a larger potential opportunity in the event of a soft landing in the US economy. So that's kind of like that one thing, last missing piece we're waiting for to see if we can have this strong of a second half. Probably will depend a lot on that recession and if we have that soft landing. So, but interesting, takeaways. So here's just some key takeaways for this, for what we've talked about so far. So the second half actually so far is off to a relatively slow start as I record this this webinar. S&P 500 is kind of battling some overbought conditions. So we will see kind of what happens there. That's just getting started though. So we'll see. Economic resiliency and a tight labor market have kept the Fed rate hikes on the table, but there is still hope of a soft landing scenario. So again, we'll see about that. Correlation analysis comparing the first half of 2023 to prior years suggests that history is on the market side. So of the 10 highest correlation first halves of 2023 since 1950, the S&P had generated average and median gains of around 12%. Again, you can see that here of around 12%. In the second half, with 9 of the 10 periods producing positive returns. So this gives us some, strong hope for the second half of the year. Of course, this is observational data, which comes with a major asterisk. Correlation does not equal causation, and history may not repeat itself. So, this is not any guarantee, but just, always interesting to see, what has happened in history in similar environments. So just moving on to inflation, this is the most recent inflation, chart. Here you see that inflation has been easing. This PCE, we have that circled here. That's obviously been easing. You have CPI. Inflation is easing. So that is really good news. The Fed's preferred inflation index, the personal consumption expenditure, so that PCE, rose 0.1% from the previous month, pulling the annual rate of inflation down to 3.8%. As base effects will pull the annual rate even lower, the investors should look at an annualized 3-month change in inflation, which fell to 3.2%. We're also just saying investors will probably not likely see inflation coverage converge to that central bank's long run target of 2% until demand for services cools off. So we still have a little ways to go to get to that 2%. We got to see some demands for services cool off a little bit more. But this is at least still heading the right direction, and we'll get those updated numbers tomorrow on July 12th. So see what that means for most recent inflation information. So that's it with that market update. That's kind of where the markets are now, as this has been recorded. But we want to get into our second half of our webinar on how to teach your kids about money. So I have just talked to so many people who did not learn about finances from their parents. Even if their parents were actually really good with money and did really well for themselves, they did not learn anything from their parents because their parents never taught them anything. They never said anything to them. And they kind of just assumed their kids would maybe just pick it up by watching their parents, but there was never conversations. So it is so important to teach your kids about money. There are, I think, only 23 states that require personal finance classes to be taken before graduation. That needs to be changed, but it has not changed yet. And so this, again, is something they're not learning at school. They're not going to learn by just watching you. This needs to be talked about. And apparently this is actually one of the main topics parents feel most incompetent in talking to their kids about, is how to teach them about money. So I want to give some tips for you guys today on what I would recommend on how to teach your kids about money, and in ways you can start teaching about money in ways that will bring about conversation for you guys. So I break it down by different lessons for different age groups, because obviously different age groups can soak in things differently, but kids are really smart. And so starting young is important because they will soak things in that you're talking about. And I start here with elementary, but some of this can even be applied to even younger, like pre-K. So apply it to your child as your child, and all kids are different in where they are developmentally too. So don't be afraid to apply this to a younger child as well, especially some of these elementary concepts that you can even make even more simple. But we're going to go through these 3 age groups today and tell you kind of some tips on what I would recommend for each of these age groups. Okay, so here for elementary age, some of the main tips I would recommend is this is actually a newer one for me. I have not done this with my kids, but I actually saw this through Dave Ramsey, and I liked it. Is using a clear jar to save money. Most young kids are using a piggy bank, or my kids always use envelopes. But a clear jar is nice because they can see it. They can visually see what they have in their jar and how much money they have. They can see it going out, getting bigger, or more coins or more dollars, or just whatever, visually they can just see it, which is really cool. But for our kids, they have always had 3 envelopes, and they've had an envelope for savings, for giving, and for spending. So you could use that clear jar, one for saving, one for giving, one for spending. Anytime they have earned money, they are split into those 3 categories. So we've always done 10% into savings, 10% into giving, and the rest can go into their spending. Now, that doesn't be the exact science that you work with, but that's just what we've done. And we've always wanted to do giving as well, because we want to teach our kids to be generous with their money. And I just think that's important to build in for, from when they're young. So, my kids actually get pretty excited. Like they did VBS this summer, and they get to go to their giving envelopes and, clean out their giving envelopes, because VBS was raising money for food for kids, that needed food. And so they were able to donate that with some of their money that they'd saved, or they've used that maybe for buying a gift for a friend, or just other things that come up that they are laid on their heart that they want to give. So again, we do those 3 categories. So, tip number 2, that's how we have them save in their envelopes. Again, you can use those jars. Tip number 2 is kind of related to that spending jar, is we allow them to spend. And there's 2 kind of tips that go along with this, and one of them's written down, the other one I didn't, so we'll just talk about it. But we allow them to spend, and that, again, 2 tips there. So have them, when they are spending, when they're going to go pick something out the store that they want to buy, it is really important, I believe, to have them take the cash and actually purchase the item themselves. I have done it both ways. My kids have forgotten their money. I'll pay you back when I get home. Please, 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 please. And I buy it there. They pay me back. It just has a different effect when that happens versus when they have their money at the store and they buy it themselves and they have to hand it over to the cashier. For a few reasons. One, I like the social lessons that is teaching them, to have to check out, to have to listen to what the cashier tells them of how much it costs, to have to hand over the money, and have that interaction. So socially, I like them to have that interaction, but also I think it's a much different lesson to hand over the money yourselves, their own money themselves, to the people for what they're purchasing. It just hits different. And it also helps them learn about taxes too. I mean, we live in a place that has sales tax. You may not, but with sales tax, if there's sales tax on the item that they're purchasing, I could put it on my card and go home and try to explain to them. And they're like, wait, you're charging me more. But when they see it there, as they're checking out, they understand, like, that's sales tax. Every time, that you buy something like that, that's going to have this % sales tax. So that's how much it costs. You got to pay a little bit extra. And so that's a good lesson, and having to hand them over. And it's just like that, like, it's their money, it's their thing they're buying, they're doing it. It's empowering them for that decision as well. So that's what I like about them handing over their own cash. The second lesson in this allowing them to spend for us has been allowing our kids to make mistakes in their spending at a younger age. And we'll see how it works out. But my thought is, if they kind of experience some of these mistakes, like, buyer's remorse at this younger age on small things that aren't a big deal, it will hopefully help them to understand, like, thinking through a little bit more about, do they really want this toy? Is this really the right way for them to spend this much money, or should they be doing something else with it? So we have allowed our kids to express, feel some buyer's remorse. Like, for example, my daughter had saved for this dog. She was younger. She was probably like, I don't know, 6 or 7. And she had saved for this, like, remote controlled dog, and at Target, and it was $50. It was a lot of money. She saved for a while for it, and she knew it's what she wanted for a while. So I let her buy it, even though I was like, that is a lot of money to spend on a remote control dog. But she had saved for it. And so I let them have some freedom in their spending. And it was like, not even a few days later that she was like, I shouldn't have bought this. That was too much money. And I was like, yeah, like, sometimes I know you did think it through, actually, and you did save for it, but it's just, like, sometimes you gotta really, you gotta really think about that. You gotta really try to analyze if that's something you're gonna want for the long run for that much money. So that also kind of leads into number 3. It shows them that opportunity cost of, if you spend your money on this, you won't have any money for this. That's a really good conversation to start having at these younger ages. So as you're allowing them to spend, you're having these conversations, you're communicating about this. This is teaching them such important things for their long run, for their life. So, they know when they spend their money here, they're not going to have money to when they go here. Or, like, we'll kind of like, oh, well, we're about to go on this trip. Are you sure you don't want to save your money for the trip for this, possibly? So if you're just starting to have them think about how they need to process what they need to spend money on. And then I would say another kind of foundational thing you're learning through elementary school, and this is building from lower elementary to upper elementary, but you're teaching them how to work for money and how to earn. So, this obviously has different parenting opinions. One of those ways would be allowance. Personally, for our family, we do not pay for allowance for chores around the home. Just Other people are going to want to do that, and that is fine. That is your thing that you want to do. That's just personally how we have done it. We have wanted to teach our kids how to earn other ways. Just because we feel like, we all live in this home, and this is part of, doing your chores around the house are part of being part of the family team of what it means to run this home here. And when you grow up, you're not going to make any money for doing your chores around your house. But again, if that's how you want to teach your kids, I would at least encourage you to give them allowance for specific work, not just allowance, just written in, like they just get $10 a week for nothing. Or maybe I know people who like, these are their chores that they have to do. And then if they do above and beyond, they get allowance. So that would be a cool way of doing it too, that I would at least recommend, maybe more than just straight allowance for, things that they should do anyways, like get ready for the day. But again, as they're getting older, you're going to build on this. So those things are changing. You're teaching them how to work for money and how to earn. And so that, as they get older, you're kind of building on that, and it's getting, more and more responsibility, or more bigger jobs basically as they're getting older, which you'll see through the slideshow. So middle school age, what I would recommend for middle school age. Again, like I said, we're building on that earning. So you're going to encourage more earning in, larger ways. Like they're getting older now, middle school. And again, this is going to depend on your child, but maybe something like mowing lawns, or babysitting, or my son has cleaned trash cans in the neighborhood, or bake sales. There's so many different ways kids can earn money. So I would encourage them to do more earning. Like, oh, okay, you're saving for that. Like, how are you going to, maybe call so-and-so and see if they want you, to come over and mow their lawn, and do their gardening, or wash their car, or vacuum their car out, or whatever it may be, but encourage them to earn more, to work more especially when they have those things they want to be saving for. Again, for my kids, we're still at this age, we're still doing those three savings, those three buckets. They're doing their spending, they're giving, and their saving. So that still applies here. I believe in middle school age, it's just kind of up now that they're making more money. And I would say, so number 6, so going back to that savings amount, now you're going to start investing that savings portion into an investment account, and you're going to start talking about investing concepts. Now, you may not feel comfortable doing this on your own, and that's fine. Hire your financial advisor to do it, to open the account and talk and start teaching them about the investing concepts, or like what funds they should be in. But start getting them investing as a middle schooler, because the more time they spend, the more comfortable they are in the market. If they start younger, being comfortable in the market, the way more successful in investing they are going to be, because they're going to begin to understand that markets go up and down, and share prices go up and down, and that when they put money, $100 in, when share prices are down, they actually get more shares. And so that's actually better for them in the long run. They're going to start to understand broad market concepts. They might not be able to fully understand like the nitty-gritty details, and that's okay. A lot of adults don't understand that yet, but as they can start understanding broad market concepts, that is going to be huge for them for their investing in the long run. So have them start investing. And then number 7, so the next thing, I would have them start paying for things, and more things, and increase their responsibility more. So that's that third tip here. Get them, it kind of goes back to like that budgeting. So you have them saving in the 3 categories, right? 10% savings, 10% giving, and then you have spending. But as they get older, the spending needs to go from when they're in elementary school and they're young, their spending is like all toys and, all things that they want. You need to start distinguishing needs versus wants. So you need to start having them pay for more things, and increase their responsibility of what they have to pay for, so that their needs that they have to pay for are slowly increasing over time, which is going to start locking in some key budgeting concepts. Like, okay, I need to, my parents say I have to pitch in for this thing here, whatever it may be that you decide. Cell phone, they want to pension for their cell phone, just a little bit, not the whole thing, just a little bit. And they know they have to do that every month, and they know they have a little bit less to spend on what they want, but they can work more to earn more for what they want if they need to. So it just starts building in just budgeting concepts slowly. And then I would say the next tip here is to open up your first bank account for them and start teaching them the concept of a debit card. So this could kind of be maybe upper middle school. And they have, a lot of times banks have like these custodial accounts, in a sense of like they're linked with your the parents' account. They're linked with your account, but it's like, getting them like a with training wheels on, basically a debit card, bank account. You're starting in use of the concept of a debit card. At this point, you've hopefully talked about that, a debit card, how it works. But this will give them hands-on experience of how it works. So your kids aren't thinking, like when they're little and they think you just hand over a card and that magically pays for something, and they don't understand the back end of what's happening. But that will help them kind of start teaching those concepts when it comes to a debit card. Okay, so then moving on to high school. as you can see, a lot of these are just taking on these similar things you built in an elementary, and we're just building and we're just ramping up at each age group. Essentially, really, you're kind of just getting ready to launch them. So I would say in high school, it's important to get them their first real job on a payroll. And the reason I say this is because I have talked to quite a few employers who hire someone for the first time. And sometimes this happens when these kids are out of college or in college, and they hire people who've never been on a payroll, and they're saying, let's say they're making $15 an hour. And this person knows that, and they know how many hours they worked, and they get their paycheck and they call their employer and they're like, you didn't pay me right. Like, this is way less than I was supposed to make. And the employer has to be like, no, those were taxes. That's how taxes work. So don't let your kid be that kid when they're out of college. Hopefully handle this when they're in high school, so they understand taxes, income taxes, when they're in high school. Now, again, they're probably not going to understand the whole income tax situation, because again, most adults don't understand that, but this will at least give them a concept enough to understand that taxes are taken out of their paycheck when they're on a actual payroll. So get them on a payroll in high school, have them have an actual job. Again, it's just ramping up from that last thing. It's more lessons than just mowing someone's lawn. It's having to be on time. It's having to clock in and clock out. It's having to do certain specific responsibilities. It's having to interview for that job and then get it. And then it's seeing, the lesson of how taxes work. So there's a lot of lessons in that. So I would have them get their first real job on a payroll in high school. Number two, I would say get them their own bank account. You're kind of taking the training wheels off now from that. Like if you, or maybe you didn't decide to do that in middle school, get them their own bank account and get them launched there with their debit card. Again, you're still helping monitor it. You're still keeping track of it with them and teaching them and answering those questions as they go. But, give them their freedom to run it and make sure that they know what happens when they overdraw. So get that, get the training wheels off for their bank account, and then start teaching them about credit cards. I know parents can do this a few different ways. And so this is at your discretion of what you'd like to do here. There's a few different things you can do. At least one, talk about them and help your child understand the difference between a credit card and a debit card. Because otherwise, as soon as they're in college, they are going to get bombarded with credit card applications, and kids who do not understand credit cards think that is, I've heard stories of kids that just think that is free money. And they don't understand how those credit cards work at all. And they get into credit card debt, and then they start getting charged those crazy interest rates, and they just are drowning in credit card debt like that. And credit card companies are banking on that. So start teaching your kids about credit cards and how they work, and how the interest is high, and how to pay them off, and how they work. Now, I know a lot of people want to start building credit for their kids. So a couple ways you can do that. Well, you can get them a credit card and monitor that. If that's how you want to teach them about credit card, that's fine. You can start teaching that with your, as you're overseeing them. But a lot of times parents will add their kids as an authorized user on their credit card, which actually will help start building their credit as well. But anyways, either way, how you do it, you need to start talking about credit cards and need to understand credit cards when they're in high school. Next tip, I would say you need to have them pay for more things. So again, we're increasing that responsibility. This is again, helping build in those budgeting things of wants versus needs. I would say if they drive, gas for their car, pitch in maybe for their car insurance, their cell phone bill, maybe their clothes. There's certain things that they do have to pay for versus what they want to pay for, like going out with their friends and food and those type of things. So increase that responsibility. Again, for these high schoolers, I think the worst things parents can do for kids is to just pay for everything all the time, and then all through college, and then drop them into the real world. Good luck. That's not going to work. Ramp them up to that. Ease them into that, because we all know that by the time you get to adults, rough, but ease them into that by teaching these lessons along the way. And it is good for kids to have responsibility, and for them to have to be, skin in the game on some of these things that they have. I would say, okay, next tip is to increase investing and start a Roth IRA. If they are on a payroll, if they are making money, start a Roth IRA, because the earlier they start that, the longer they have for that is going to be huge in their investing success, and make retirement planning so easy for them. So start that Roth IRA and increase investing. You can do that, maybe they start safe for college too, but get that going, ramp that up from middle school to high school, get that a little bit more going a little bit more. And then the next thing I would say is discussing college costs and loans relative to salary from career. And what I mean by this is, Well, one, they're getting ready for college. You need to start talking about college costs. And in talking about college costs, inevitably you're going to talk about loans and how to pay for college. So I would say, one, start talking about ways you can save on college. That's a way to go about it as well. Maybe they go to a junior college first. They go to a cheaper school, state school. Maybe they live off campus. I know there's rules for freshman year a lot of times, but after freshman year, maybe they live off campus, have roommates, make it cheaper that way. So you're just figuring out a college plan of how you're going to make that work. That is going to include talking about loans. And I think it's incredibly important to say this, but college debt, school debt is not good debt. I know that has been sold. This is good debt. This gets them started in their life. I have talked to way too many people who have student loans from careers they don't use. They didn't finish college, or they decided to change their major because they had no idea what they wanted to do. And they have all the student debt for like really low paying jobs. That is not wise. So try to avoid loans if at all possible. And I would say like teach your kids to work through school. They should maybe be working through college too, pitch in for it. There's that route to go as well for trying to save money and give them some skin in the game in college and get them a little bit more invested. But also, if I know it's not completely avoidable for certain people in certain careers to have to take debt. I get that. If you're going to be a doctor, that's a long career. That's a long school path. That's hard to pay for out of pocket all the way through. Totally get that. But you do need to analyze how much loans you are taking versus the career and what your salary will be in that career. Because to take $200,000 in student loans to become a teacher is going to not put you in a great spot. So you need to think about how much you're taking in loans versus how much you're going to be making to pay those off. And again, I would say avoid most loans, if at all possible, avoid as many loans as you can, or loans in general. But for those that have to, make sure you know exactly what you want to do, and you know how much you're going to get paid when you get there to be able to pay those loans off, and have that plan in place beforehand, before you start taking those loans. Otherwise, with these kids that just end up with so much loans, they are just so far behind, and it is just, it's terrible. It's a lot of pressure to graduate with. So, that is my encouragement there with college costs. And again, this is a great place to be working with an advisor on college planning. This is something that an advisor can really help with in breaking down college planning. So, if that is something that's an unknown, then sit down with an advisor and work through that and work through a plan for that. So you know specifically what you'll be doing. So basically what you've done, if you kind of take some of these tips and you're applying them over these ages, you are teaching core concepts throughout, and you're teaching budgeting. As you're gradually increasing what items your child has to pay for, they're learning to budget and spend wisely. They're learning needs versus wants. They're starting to learn how to budget. And again, you're going to ramp this up even further in college. Like you're slowly taking more and more training wheels off, basically. Investing, as you begin helping them invest their savings, they're going to begin to understand how investments grow. They're going to get their feet wet with how investments work. They're going to understand markets. They're not going to understand what's causing markets, but they're going to understand how markets go up and down. They're going to get those main concepts, which are huge for them in the long run. Debt, teaching about credit cards and student loans will be crucial to helping your child start off on the right foot as a young adult. And understanding how debt works, understanding how long it would take to pay off certain loans. All these concepts are so huge from the beginning, learning from the beginning. And then you're teaching them how to earn, you're teaching them how to work hard. As your child has to pay for more things, they will understand they need to work more. This will help them understand they have to work hard for the things that they want. If I bought my son every surfboard my son wanted, he would not learn how to work hard. It would be like, just ask mom for another surfboard. And he wouldn't learn a lot of valuable lessons that are coming with him, these surfboards. But me saying, you want another surfboard, that's on you. It's him earning. It's teaching him how to earn, but it's teaching him like, I know you want another surfboard, but you also need to pitch in for this. So he again, kind of goes back to that budgeting. And so there's just all these concepts are just building into these tips that I'm giving you here. And it just will really help your kids as they enter the real world, as they get older. My goal always is to just provide, just bring that confidence as an investor, confidence with your finances. And so that is always the goal here at Selah. So just a little bit, kind of pivoting back to Selah. Now that we're kind of like finished with that money talk of how to teach your kids about money. This is the Selah process that is trying to always build confidence in my clients. So we always start with that, comprehensive needs analysis of what you have going on, because everyone has something different going on. Moving into like that custom solution, and then we have accountability and implementation along the way. That's with that continual refinement. We do strategy sessions because life is always changing. So that's why I said, if you need a a college plan, an education plan to figure out how you're going to make this work for your kids, that's something we put together to give you, so that you have that confidence of like, okay, we know how we're going to do this. We're not like in the what ifs. We understand actually how this is going to work. And that just brings confidence to your finances, and your other finances as well, because you know how this one's going to work. It makes, it takes pressure off the other side. So, that is always the goal here at Selah. Here's just a little bit disclosures about LPL Financial, my broker dealer that I go through. And then here's some more disclosures as well. And then ways to get in touch with me, email, phone number, that's my phone number, and text line 949-942-8805, website, Instagram, Facebook, YouTube, and the Confident Dollar podcast. So if you're listening to this audio, obviously you already know about that. But these are all ways I want people to continue to get educated, to continue to feel empowered with their investments. And so, stay in touch and stay on these webinars to continue that for yourself. So thank you everybody for being on here today. Again, I'll get to those questions to you personally that came through. But I appreciate you all taking the time. I hope you have a great rest of your week, and we'll see you at next month's webinar. Thanks.